My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College, and in this video we are going to discuss short-term discounted notes payable. So in one of the previous videos we talked about a traditional interest-bearing notes payable where we borrow one amount early and then accrue interest and pay the note both principal and interest at the maturity date. Short-term discounted notes payable work a little bit differently. In effect, what happens is we simply borrow a discounted amount today and then repay the face value of the note at the maturity date. And we're just going to look at a very simple example. So a company is issuing a $5,000 note payable discounted to $4,850 with the face value payable in 6 months. The face value of the note is the $5,000. What we are getting today is $4,850. Notice here that there's no interest rate that's necessarily stated, but rather the interest is implied. We borrow $4,850 today, and 6 months from now we repay $5,000. The difference between what we borrow and what we repay is going to be classified as interest, the cost of borrowing. So let's take a look and see how this is going to work from a valuation and recognition and a disclosure perspective. So we've got our timeline here, and similar to the previous video, we are looking at issuing this note September 1st, repaying it on March 1st, 2014, which means that December 31st, our fiscal year end, falls in between those two transaction dates. So what we need to do is we need to first figure out how much total interest is going to be paid on this note. That's actually fairly straightforward because that's just the difference between what we are borrowing today, the $4,850, and the $5,000 that we will repay the lender on March 1st. So our total interest here is going to be $150. The other thing that we need to do is make sure that we apply the matching principle and ensure that we record interest expense in the correct period. The $150 is for the entire 6-month period of time. Only part of that will apply to 2013, and then the remaining portion is going to apply to 2014. I'm sorry, $150 total. Part of it applies to 2013, part of it applies to 2014. Because we're dealing with a short-term time frame, what most companies will do is just simply use a straight line method of amortization. And so the note has $150 of interest that will cover the entire 6-month period of time. 4 months of that is in 2013, and 2 months of that is in 2014. And so we'll use 4/6 and 2/6 as our means of allocating interest to the correct time period. That means that 2013 interest will be $100. The note is outstanding for a total of 6 months. 4/6 of that, or 2/3 of the time, is in 2013, and so 2/3 of the entire interest expense is going to get allocated to 2013. That means that the remaining portion of interest will be applied to 2014. So it's just a simple straight line amortization. Whatever portion of the period applies to 1 year, we'll take that proportion and apply it to the total interest cost, and then whatever's left over gets applied to the subsequent year. Now, there's also something else that we need to be concerned about, not from a recognition or measurement process, but more from an analytical process. Remember here that the interest rate is not explicitly stated in this note. However, there is interest. We know that, and we can determine or estimate what our implied interest rate is. So here's the deal. We are going to pay $150 of interest to borrow $4,850 for 6 months. So the total amount of interest that we're paying is $150. The amount that we're actually borrowing, the cash that we get on September 1st, is the discounted amount of $4,850. And we have the use of that money for 6 months. And so the way to compute or determine the implied effective interest rate is to take the interest cost of $150, divide it by the amount that we are borrowing, $4,850, and then we need to annualize that. We're borrowing this for 6 months out of a year in total, and so we multiply it by 12/6. So that will annualize the interest rate for us. If this note were a 9-month note, then we'd be multiplying by 12/9. If this was a 4-month note, we'd be multiplying by 12/4. And so $150 of interest cost divided by $4,850 times 12/6 yields a 6.19% effective interest rate. So that's how we can compute effective interest on a discounted note. Even though the note does not explicitly state an interest rate, we have an implied interest rate here. Okay, so now we can go back to the actual financial accounting issues here and deal with the journal entries. So September 1st, we obviously have a journal entry to recognize the borrowing of the money initially. December 31st, we are going to have an adjusting journal entry to recognize the accrual of interest, and then March 1st, we will actually pay off the note. So let's deal with what happens in 2013 first. September 1st, the transaction is fairly straightforward. We debit cash and credit notes payable for $4,850. Even though that's not the face value of the note, we can use a net approach to recording the transaction. We collected $4,850 in cash, and we created a note payable or an obligation to pay that back at some point in the future, and that gets recorded at $4,850. December 31st, we need to deal with the interest. Remember that the interest calculation was $150 in total, with $100 of that applying to 2013. Well, that simply just gets added to the notes payable. Remember, there is no interest payable here. We're not separately paying interest and the note payable or the principal amount. That becomes a combined item on discounted notes payable. So the transaction here on December 31st is to debit interest expense. That's an income statement account. That will get the interest cost recognized correctly on the income statement, and we add that $100 to the notes payable. And so that's the journal entry, or the adjusting journal entry, that is needed as of December 31st. In terms of a balance sheet disclosure, this is a short-term note. It's only going to exist as of December 31st. It's only going to exist for another 2 months, or is expected to be paid in another 2 months. And so it's definitely a current liability. And notice now that the balance in the notes payable account is $4,950. $4,850 original credit entry, and now we've added $100 to recognize the interest. So the balance in the note payable account is $4,950. Now, just to complete the cycle, we'll take a look at what also happens in 2014. On March 1st, when we pay off the note, we could combine this into a single transaction, but for teaching purposes here, I've separated this into 2 separate transactions. We need to record the remaining amount of interest that is needed to be recognized, $50 of interest expense to be recognized in 2014. That again gets added to the notes payable account. So we debit interest expense, credit notes payable, and then we pay the note. Remember that as of the end of 2013, the note payable had a balance of $4,950. We just added another $50 to that account, and therefore it has a balance of $5,000, which is exactly what we owe the lender. We borrowed $4,850 to begin with and agreed to pay $5,000 6 months subsequent to that. And so now we are going to eliminate the notes payable from our balance sheet by debiting notes payable for $5,000. That will draw that account down to a zero balance. And we will also credit cash for $5,000 as a result of paying off the note. So those are the major issues that are of concern when we are dealing with a discounted note payable. The key to remember is that discounted notes payable will very often not have any specified or explicit interest rate. What happens is there's a face value to the note and we get something less than that to begin with. That is the discounting effect. The difference between the discounted amount that we receive today and the face value that we pay at the maturity date, that difference is interest expense. So it's not explicitly stated, but it is implied in the transaction.